begin investing in ETFs. An ETF, or exchange-traded fund, is an investment vehicle that tracks the return of a particular index or sector. ETFs are an alternative to mutual funds, which are not as well suited to trading in the short term. An ETF is a security that holds other securities. The price of the ETF changes based on how those holdings change in value. For example, if Google stocks go up by $1, then $100 worth of shares would be added to the ETF's portfolio and the price would increase by $1. If you're looking for simplicity and diversification in your investments, then there are many reasons why investing in ETFs might be for you. The next section will outline some of these reasons and provide steps for how to invest in an ETF on any find and investing platform. ETFs are available on most online investing platforms, retirement account providers, and investing apps like Robinhood. Most of these platforms offer commission-free trading, meaning you don't have to pay fees to the platform providers to buy or sell ETFs. While it is true that no commissions are applied to ETF purchases, there are still costs that will need to be paid. Some areas in which platforms can offer their services better than others are convenience, service quality, and the available number of customer support. For example, smartphone investing apps enable ETF share purchase at the click of a button. This may not always be the case for other brokers, as they may ask for important paperwork or more complicated situations. However, some well-known brokerages offer extensive educational content that helps new investors become familiar with and research ETFs. Research ETFs. The second and most important step in ETF investing involves researching them. There are a wide variety of ETFs available in the market today. One thing to remember when you're researching investment funds is that they behave differently than individual securities like stocks and bonds. This can be a considerable investment. It's important that you consider the wider picture, including the industry it relates to. You should ask yourself these sorts of questions. Exchange-traded funds (ETF) are a type of fund which can be traded on the stock market. An ETF is a type of fund which mirrors the financial performance of different assets such as stocks, bonds, and commodities. They are called exchange-traded funds because they can be bought and sold on stock exchanges just like individual stocks or shares. The advantages of ETFs include the ability to invest in a sector or index that you would not normally have access to and lower fees than mutual funds. ETFs can be a great way to invest for growth and income. An ETF is an investment vehicle that tracks the performance of a specific index, commodity, bonds, or a basket of assets. They are traded like stocks on an exchange and can be easily bought and sold. Most ETFs are passively managed, which means that the fund manager buys the underlying assets in the same proportion as they are represented in the index that they track. ETFs typically have low management fees, which makes them a good investment option for a wide range of investors, including those who want to grow their money over time as well as those who need more immediate income from their investments. ETFs have been around since 1993 when State Street Global Advisors first introduced them on U.S. markets with their S&P 500 tracker SPDR Trust. Some good trading strategies are dollar cost averaging or spreading out your investment over time. Particularly if you are a beginning investor, these tactics can be helpful. This is because it smooths out returns over time and ensures a disciplined, as opposed to haphazard, approach to investing. It also helps beginning investors learn more about the nuances of ETF investing. When they become more comfortable with trading, investors can move on to more sophisticated strategies like swing trading and sector rotation.